This is Golden Years, a roadmap to navigate retirement with Mark Cordner, the podcast.
You know, October is one of the most feared months on the financial calendar. It's because that's when history has seen some of the biggest events that have shaped the stock market, including the bank panic of 1907. It stretched for 6 weeks and resulted in bank runs and panic selling. It's kind of a big deal. Of course, you got the stock market crash of 1929. We all know about that. Of course, it put us in the Great Depression. And last but not least, Black Friday happened in 1987 when the Dow dropped 22%, but recovered rather quickly. So it's not just Halloween and skeletons that you have you running, apparently. October's got a lot going on here. It's led to what's called the October effect, the psychological anticipation that Wall Street crashes are more likely to occur in this month than any other. So, Mark, is there a reality check on that? Where do you stand here?
Well, I've got mixed feelings about discussing this topic because it unfortunately it can kind of become a self-fulfilling prophecy. You know, if people anticipate this and start pulling money out of the market, then that's exactly what it does. It contracts the market. So my general belief is based on a ton of academic research, 3 Nobel Prize winners' work in particular. And my belief is we got to quit playing these games. We got to be humble enough to admit that God alone truly knows what's coming in the market, and to try to predict what's going to happen in a given month is really foolish. Unless you're planning on liquidating your entire retirement account in a single month of October, then I would say don't worry about this. We should be thinking about the next 2 decades and not the next 2 weeks. True investors truly are oriented to decades. And so we take the long-term approach. I've spoken frequently in the past about my strong belief that a portion of everyone's portfolio going into retirement needs to be principal protected, meaning a portion of their money should be out of the market and should be completely safe. Now, why do we teach this two-pocket approach, as I call it? It's simply because when the market goes down, it would be nice to have a safe place we can go to that's not been affected in any way by the market. That thereby buys us time for the market-based portion of our portfolio to rebound. So we can pull from that when it's going up, you know, and not when it's going down. If we tap into variable accounts, typically market-based accounts, mutual fund-based accounts, when the market is down, all we're doing is accelerating the premature depletion of that account. And we don't recommend that. So again, the two-pocket approach makes us nimble. It allows us to respond to whatever life brings. None of us has a crystal ball. And let's just quit pretending that we do. And let's structure a plan that's designed so we can respond to whatever comes. And then we go live our lives and don't get all anxious about what's may or may not be coming in any given month. That's, I think, a horrible way to live.
No, yeah, I couldn't agree more. And, you know, no one has a crystal ball, as you were saying. If you did, life would be a lot easier. And, you know, I mentioned one of the doom and glooms there that happened in October is, of course, the Great Depression. Now, if your parents are of that generation or your grandparents, honest to God, they're still talking about it. I know my grandparents were when it came to money or hiding money in the bricks or how much is a loaf of bread, and now they're freezing milk. I mean, it was a whole thing because they were just convinced this is going to happen again. And I know that the current state of the economy, quite frankly, the country has a lot of folks worried that we're going to end up right back there. We could have one of the worst recessions we've ever seen. Quite frankly, they've had predicted that we're going to have a bad recession. You know, what are your thoughts as you talk about, you know, the two-pocket approach and getting that protection in place? Is this something that we need to do right now, today, make a phone call? Or is this, you know, as we start seeing the bricks to slowly start falling, then we give you a call?
Well, I don't think you jump off of a roller coaster when it starts going downhill. Roller coasters go up, roller coasters go down, and we need to ride it all out. And that's how the stock market is. So my point is simply we don't use the stock market for all of our money. There's ways to get very respectable rates of return outside of the market and eliminate that anxiety. Certainly, we don't want to be trying to read the tea leaves and you know, as you say, as the bricks start crumbling, as it were, then try to react, because then we're typically locking in the losses. So my belief is you set up this two-pocket approach. You set up a long-term plan that's structured to withstand whatever may come. But we don't just let our anxiety spin thinking about what may happen. There will be hard hits in the future. There's no question about that. There will also be wonderful times in the future. I'm personally of the belief that we're going to experience the best of all times and the worst of all times in the coming decade and two. We're in a period of incredible innovation, The world is changing at a speed that we've never seen in the history of mankind, and that gives me tremendous optimism about the future.
Mm-hmm.
Now, at the same time, I recognize that that's going to bring with it some painful episodes like these dips we've seen. Think of the pandemic, that big drop we had in the market, and then how quickly it rebounded within a matter of months. So, again, things we cannot predict in terms of when it's going to happen or how long it's going to endure. And so my belief, again, is we set up this two-pocket approach and we safeguard ourselves through that so we don't have to get all anxiety-ridden. So if this appeals to our listeners, if there's any of them out there that are, experiencing anxiety with all the things that these crazy media types are saying, then come visit with us. We can show you strategies. What we really focus on are strategies for safeguarding money, because the methods we had to accumulate money are not what's going to carry us through the distribution years. So those years where we're pulling money out, actually living on it, that's an entirely different set of rules, a different game plan entirely. If anyone's out there and anxious, come visit with us. We do this complimentary consultation, and let us relieve you of some of that anxiety and show you how you can go live your life and not worry about these things.
You may have seen the beautiful, amazing Brad Pitt in the baseball movie Moneyball, and you've seen that movie, right, Mark?
I have, yeah.
Incredible movie. It was the story of the 2002 Oakland A's and how their manager used data and not just gut feel to build his team. So got me thinking here, when you're building a retirement plan, do you throw in, data? Is that usually what's going to win, or do emotions still play a big part of making decisions?
Oh, wow. Yeah, that is a loaded question. It's both do. They absolutely do, because we're human beings. And so certainly there has to be a lot of reason. There has to be a lot of time and thought that goes into this. And certainly the data needs to be analyzed to see through a gazillion different scenarios, what's the probability of success here? A lot of it has to do, though, with expectations. And so, how much a person wants to spend makes a world of difference. Sometimes people will come in with some very unrealistic expectations. They want $10,000 a month, even though they've never earned $10,000 a month. And those who have earned $10,000 to $20,000 a month often want $5,000 or $6,000 a month. So it really, no two people are alike. It really depends on what their expectations are, and also their family circumstances. What are their goals in terms of leaving a legacy? There's emotional issues there, obviously. What are their health challenges? What's the likelihood of them living a long time? Is there great longevity in the family? Interestingly, those who have had very health-minded habits over the years, those who have exercised and all those things, tend to be the ones who live longer, but their minds then go out. Their body lasts, but the mind doesn't. And so we've got long-term care kind of issues we've got to consider. And so there's a lot of emotion that comes into play. And that's why I always tell people the quick answer is rarely the best answer. And I just don't do business in the first meeting. This is all about listening, about understanding what's important to people, and then helping create some realistic frameworks for their expectations. Some people come in and they're entirely focused on what rate of return can you get for me? And that's the very wrong thing to focus on. Certainly financial advisors should be able to help you get better than average returns. There should be something extra, premium as we call it, some extra results from their expertise, but it's not all about the return. Retirement really is about risk management more than anything. I just say we've got to respect the client's feelings. We've got to talk through that. The biggest issue, I think, is, are they open-minded? With my firm, we don't have a minimum financial dollar amount that they have to qualify to work with us. We're not like the most firms that say you have to have $1 million or more. In fact, we tend to focus on people who have less than $1 million. But there are 3 criteria to work with my firm. One is people have to be nice, and they have to be positive people. They have to, when I say positive, I mean they have to have a brighter view of their future than they do of their past. So they have to be nice, they have to be positive, and then number 3 is they have to be teachable. And when I say teachable, I just mean open-minded. Are they open to strategies perhaps that they've never heard about? And I'm not saying they have to embrace them in the first conversation, but are they open to learning? For example, home equity management. I'm completely convinced that half of retirees are going to have reverse mortgages in the next 15, 20 years, and for good reason. There's incredible misinformation out there on this topic. But to the degree, for example, people are open to looking at home equity as being an asset that's considered in retirement planning. We can do some incredible tax planning for people, and we can typically improve their income, certainly their estate, by a good 25 to 35%. So it really just depends on the person. And so, yeah, we have to look at the data. We definitely have to look at the emotions, because that's what drives people's willingness to actually act.
Mm-hmm.
And the information we provide is no good unless people act upon it. There's a famous tax judge that once said that there's two sets of rules for taxpayers, one for the informed and one for the uninformed. Now, my mentor added a third rule, and I thought he was very wise in doing this. He said, no, he said, there's a set of rules for the informed, there's a set of rules for the uninformed, and then there's a set of rules for those who are informed but never do anything with the information. And that's what I often find to be the challenge, is that people will come in with predetermined ideas, and if they're not willing to be more open-minded, then we can help them, but it's going to be limited in what we can do, because certainly we've been exposed to more ideas over the last 32 years, and hundreds of people that we've met with have been exposed to more ideas than your average Joe off the street.
Investment advisory services offered through Golden Years Financial LLC, a registered investment advisory firm. Insurance is offered through Golden Years Insurance Services. These firms do not provide legal or tax advice. Consult your own legal and tax advisors before taking actions that may have tax implications. Investing in securities involves risk, including the potential loss of principal. Insurance contracts' principal protection is based on the claim-paying ability of the respective insurer. None of the information contained on this website shall constitute an offer to sell or solicit to buy a security or insurance product. The information and opinions contained on this site or requested from this site are provided by third parties believed to be reliable, but accuracy and completeness cannot be guaranteed. They are provided for informational purposes only and are not a solicitation to buy or sell any of the products mentioned. Any media logos and or trademarks contained herein are the property of their respective owners, and no endorsement by those owners of Mark Cordner, Golden Years Financial, or Golden Years Insurance is stated or implied.